But let's talk a little more about the markets now, and Sanchita Mukherjee joining us. Hi, Sanchita. Always a pleasure chatting with you. Thanks for coming to our studios. Today, we're not seeing jitters on the Lal Street. It is expiry day, at least not when it comes to the frontline indices. But I think our markets have been pretty directionless the last couple of months. Maybe the global cues were at play now, and earnings season is behind us. But you've got general elections coming up. So do you think it's going to stay this way and volatility is going to be the flavor of the season?
Yes, absolutely.
Yes, absolutely, Nandara. You have correctly hit the nail on the box. The markets have been very range bound, and I do see going forward the markets will continue to be range bound with spurts of volatility because domestically there's a credit squeeze that has been happening, and also there's a lot of discussions on the NCLT, the NPA resolution which is taking place, because of which the credit squeeze has been happening, the general elections of 2019, and of course the joker in the pack, oil prices. Now, having said that, I do not see a huge current upside from where we are because emerging market valuations are steep, and within that pack India looks expensive. But having said that, I do not see a huge downside either because there are pockets of value, there are opportunities across sectors. It's a very, very stock pickers market, and there's a lot of opportunities within sectors to evaluate companies that are doing fairly well. So corporate performance is also coming out as a key factor, and if you were to see right now, corporate performance after this entire earnings season has been quite interesting in terms of raw material, commodity players have posted good results, but converters, people who use raw materials, they've had their margins squeezed. So it's been interesting times.
But Sanchita, that would be the trend that's going to... like you've talked about rising input costs because right now it's not even being passed on. For example, look at FMCG, that still has to get more expensive. We're going to see more inflation as logistics gets more expensive. So keeping that in mind, the fact that, we're perhaps going to be in an era of slightly higher inflation, which are the safer sectors, and are people like you maybe rejigging your portfolios?
Yes, absolutely.
Yes, absolutely. What you've mentioned correctly is that right now, in the current time, the pricing power is just not there, due to which the margins are being very badly squeezed. But having said that, we are expecting a very good monsoon this year. So once the demand sets in, the pricing power would come, the costs would go down to the customer end of the day, and I think that would really contribute to the corporate performance. So sectors which look good actually would be logistics. There's a lot of e-commerce business happening. You look at Amazon, Flipkart, all of this. Logistic business would do well, fairly well in the long term. Also specialty chemicals, the affordable housing segment, retail lending, these would be the sectors that one should watch out for.
Sanchita, hi, it's Karanya as well joining in the conversation. A lot of HNIs have been betting on specialty chemicals, and you have also listed that as one of your top bets. Could you tell us what's making you so optimistic about this space, and what do you think is the way ahead for the sector?
Within specialty chemicals, there are certain companies who would be having, say, a monopolistic, almost a dominant role globally in manufacturing chemicals which are intermediaries for across all industries. So for customers who are invested, looking at that as a theme, one has to identify stocks within that sector which have that dominance in terms of manufacturing very, very specialized chemicals where you do not have a presence like, say, China as a player.
Sanchita, it's lovely chatting with you like always. Thanks so much for taking time out and sharing with us some of your top sectoral bets and your overall perspective on the markets.